Technical analysis patterns. Trading chart patterns are one of the technical analysis methods intended to define market turns and trends. Trading chart patterns help you see whether the price is likely to continue its direction or go reverse. There are two types of chart patterns: trend continuation patterns, trend reversal patterns. Trend continuation patterns are formed during the pause in the current market trends and mark rather the movement continuation than its reversal. The ascending triangle is a trend continuation pattern typically formed in an uptrend that serves for existing direction confirmation. The descending triangle is a trend continuation pattern typically formed in a downtrend that serves for existing direction confirmation. The symmetrical triangle is considered a trend continuation pattern and may be formed in both uptrends and downtrends and serves to confirm the direction of an existing trend. The bullish rectangle pattern serves for existing trend confirmation. The bearish rectangle pattern serves for the existing direction confirmation. It is mainly formed on a downtrend and means a high probability of continued decline in the value of the asset. The flag is a minor, short-term trend continuation pattern that shows the previous direction will prevail in the future after its formation. The pennant is a minor, short-term trend continuation pattern that shows the previous direction will prevail in the future after its formation. The VET graphical price model is a minor, short-term trend continuation pattern that shows the previous direction will prevail in the future after its formation. Trend reversal patterns represent geometric models on the charts, which are formed after the price level has reached its maximum value in the current trend. These patterns serve to indicate that the ongoing trend is about to change its course, and their recognition helps to identify the end of the trend and the beginning of a new movement. The head and shoulders pattern is typically formed in a developed uptrend. The inverse head and shoulders pattern is typically formed in a developed downtrend. It is believed that the longer it takes for the double bottom and double top patterns to be formed, the more reliable they are. The triple top pattern is considered more significant than the double top pattern. The triple bottom pattern is considered more significant than the double bottom pattern. Traditionally, the diamond chart pattern appears in an uptrend.